Retail Banking Module A Unit 1. Retail Banking Introduction. Objectives. The objectives of this unit are to understand the history and definition of retail banking, characteristics of retail banking, advantages and constraints of retail banking, retail banking scenario in India, why retail banking, factors for success, challenges, future strategy, global trend in retail banking. Introduction. Retail banking refers to provision of banking products and services offered to individual customers, typically for non-entrepreneurial purposes. On the liability side, banking has generally been retail, i.e., the banks are raising resources generally from a large number of retail depositors. In asset side also, the case is not different. Thus, on the whole, retail banking involves offering of products of both sides of the balance sheet, example, fixed deposit, current savings accounts on the liability side, and mortgages, loans, example, personal, housing, auto and educational, on the asset side. Additionally, retail banking also involves offering of credit cards, depository services, parabanking products, and services with insurance products, capital market products, etc., to individuals. Typically, retail banking begins with a target clientele, which is the common masses, and it slowly graduates through a stage, which can be called as class retail banking. The mass retail banking is the stage in which the bank provides standardized banking products and services to its customers. In this phase, the banks attempt to build a sufficiently broad customer base which can serve as a stable source of funding. The class retail banking, on the other hand, is the stage in which the bank offers customized products and services targeted at a niche customer segment, the high net worth individuals. Retail banking focused solely at a niche customer segment may also be termed as private banking. A graphical representation of the positioning of mass retail banking vis-a-vis other segments of banking is as under. Go through the figure. Definitions. What is retail banking? Let us see the different definitions of retail banking. Retail banking is a banking service that is geared primarily towards individual consumers. Retail banking is usually made available by commercial banks. Unlike wholesale banking, retail banking focuses strictly on consumer markets. Retail banking entities provide a wide range of personal banking services, including offering savings and other operative accounts, bill-paying services, as well as debit and credit cards. Through retail banking, consumers may also obtain mortgages and personal loans. Although retail banking is, for the most part, mass market driven, many retail banking products may also extend to small and medium-sized businesses. Today, much of retail banking is streamlined electronically via automated teller machines, ATMs, or through virtual retail banking known as online banking. Retail banking deals with lending money to consumers. This includes a wide variety of loans, including credit cards, mortgage loans, and auto loans, and can also be used to refer to loans taken out at either the prime rate or the subprime rate. Retail banking refers to banking in which banking institutions execute transactions directly with consumers rather than corporations or other entities. Retail banking refers to the part of a bank's operations providing services at its branches for small, in bank terms, account holders. Banking services offered to individual customers such as savings accounts, retail loans, remittance services, etc. Pure retail banking is generally conceived to be the provision of mass market banking services to private individuals. It has been expanded over the years to include in many cases services provided to small and medium-sized businesses. Some banks may also include their private banking business, i.e., services to high net worth individuals, in their definition of retail banking. Characteristics of retail banking. The definitions of retail banking as discussed above bring out the following characteristics. 1. Banking facilities targeted at individual customers. 2. Focus towards mass market segment covering a large population of individuals. 3. Offer different liability, asset and a plethora of service products to the individual customers. 4. The delivery model of retail banking is both physical and virtual, i.e., services are extended through branches and also through technology-driven electronic off-site delivery channels like ATMs, internet banking, and mobile banking. 5. Extended to small and medium-sized businesses. 6. Today's retail banking encompasses multiple products, multiple customer groups, and multiple channels of distribution. Advantages of retail banking. 1. Client base will be large and therefore risk is spread across the customer base. 2. Customer loyalty will be strong and customers tend not to change from one bank to another very often. 3. Attractive interest spread since spreads are wide, since customers are too fragmented to bargain effectively. Credit risk tends to be well diversified, as loan amounts are relatively small. 4. There is less volatility in demand and credit cycle than from large corporate. 5. Large numbers of clients can facilitate marketing, mass selling, and the ability to categorize select clients using scoring systems data mining. Constraints in retail banking. Though retail banking as a segment has a number of embedded advantages, the segment suffers from constraints too. A few of the constraints are as listed below. 1. Problems in managing large numbers of clients, especially if the available IT systems are not sufficiently robust. 2. Rapid evolution of products can lead to IT complications. 3. The costs of maintaining branch networks and handling large numbers of low-value transactions tend to be relatively high. For this reason, banks are encouraging clients to use cheaper distribution channels, such as ATMs, the mobile or the internet for these transactions, and reserve the branches for higher value-added transactions. 4. Higher delinquencies, especially in unsecured retail loans and credit card receivables. 5. Any loss in faith in a particular bank can lead to sudden outflow of retail deposits resulting in collapse of the bank. This is called a bank run. Evolution of retail banking. Having understood what retail banking is all about, let us see the evolution and history of retail banking. Retail banking as a business model. Retail banking, as a business model of banks, had evolved over the years from the traditional banking space. Historically, banking in the Indian scenario before 1960s was identified with lending to business and corporate clients for working capital and project financing. The traditional forms of banking in the above period was restricted to class clients and satisfied their total banking requirements in the form of financing for raw materials, work in progress, finished goods, and bills receivables. For delivering these services, various products, instruments, and facilities were introduced to serve the corporate customers. The operative accounts, like current accounts for extending the above services, formed an integral part of the services. The basic premises under which these services were structured were that the needs and requirements were straight and simple. But over a period of time, as the needs and wants of the customers expanded and more products and services were needed, banks had redesigned their product and service paradigm. There was an absolute need by banks to develop specialized and sophisticated products to meet the manifold and diverse growth of organizations. The stage had come where the legacy architecture of banks was unable to service the diverse needs, and hence emergence of banks with functional focus came into existence. From being plain vanilla commercial functions, banks took new avatars like investment banks and merchant banks to carry out the investment side of banking and also corporate capital raising, fundraising and debt structuring activities. Investment function was hived off as a separate activity, and also standalone investment banks had emerged to take care of the multi-dimensional functions of investment banking, mergers and acquisitions, etc. Merchant banks were the answer for capital and debt raising and other related activities. But the buck did not stop there, as banking was always on the explosion mode and there was absolute necessity for banks to reposition themselves with newer business models to satisfy the ever-changing needs of the existing customers and also to cater to the expectations of the new class of emerging customers. As the evolution of banking was a continuous process, with the broadening of the customer base, and the character of the customer's base changed from homogeneous to heterogeneous over a period of time, banks were under the compulsion to redesign their products and services models to cater to these customers and fulfill their varied needs. Thus came corporate banking and retail banking. In some banks, retail banking was christened as consumer banking, as the focus was towards individual consumers. Capgemini brings out World Retail Banking reports from time to time. The World Retail Banking Report 2015 was released by Capgemini and European Financial Management and Marketing Association, EFMA. The major findings were: banks are falling short of customer expectations. Customer expectations are on the rise at a faster pace than banks can handle. Positive customer behavior is also on the decline. The shift is mainly on account of younger generation, who are less likely to take debt, more likely to leave, and less likely to refer friends or buy additional retail products. Times competition from non-bank players is accelerating. Banks are still unsure about the impact of non-bank players, and this may lead to threat to core business in future. Banks focus too much on the front end at the cost of back-end service. Banks need to continue to invest in the front office because that is the first interaction for the customer experience. But, at the same time, they can no longer defer the significant efforts required on the middle and back end because the clients don't want to be exposed at the back end and do not accept that it takes 3 weeks to be provided with paperwork, etc. The World Retail Banking Report 2016 by Capgemini and EFMA found that 63% of customers across the globe are now using fintech products or services. Penetration is currently highest in the emerging markets and among younger customers, but is expected to increase in all geographies and ages. While 96% of banking executives agreed that the industry is evolving towards a digital banking ecosystem, only 13% say they have the systems in place to support it. Fintech providers are gaining popularity among consumers thanks to the perception that they are easy to use, offer fast service, and provide a good experience. Only 36% of banks agree that fintech offer fast service, and only 40% agreeing that fintech provide a good experience. Competition is evolving into acceptance, with 65% of bank executives saying they view fintech firms as partners. Retail banking scenario in India. The evolution of retail banking in India can be traced back to the entry of foreign banks. The conventional banking business by public sector banks, PSBs, was done on a more generalized approach, and there was no specific demarcation as retail and non-retail activities. Customer and industry segmentation was adopted within the overall business plan of banks. Offering products and services based on specific consumer segments was not attempted in a focused way. Foreign banks operating in India set the trend and in the late 1970s and early 1980s and came out with their consumer banking models with hybrid liability and asset products specifically targeted at the personal segment. Standard Chartered Bank and Grindlays Bank were the pioneers in introducing these types of products. Citibank created waves in the early 1980s with their credit card products and spurred the retail banking space. State Bank of India and some public sector banks like Indian Overseas Bank, Bank of India, Bank of Baroda, and Andhra Bank developed and marketed asset products and card products to cater to retail segment. In fact, Bank of Baroda and Andhra Bank were two of the early players in the credit card business in the PSB space. The entry of new generation private sector banks in early 1990s has created a new approach to retail banking by banks. With the advantage of technology right from start, these banks had a clear positioning for retail banking and aggressively strategized for creating new markets for the retail segment. In addition, the new generation private banks had posed a threat to the retail business of foreign banks that had by then well-defined business models for retail banking. To add to the fuel, PSBs also with technology initiatives and redefined business model for retail had aggressively entered the market space, creating a retail war and capture their share of the pie in the liberalized economic environment and the resultant opportunities in retail banking. The retail war is in full swing now with a win-win situation for all the players and the focus is on capturing and improving the market share and customer base. Strong economic fundamentals, growing urban population, higher disposable incomes, rise in young population, emergence of new customer segments, and rise in the mass affluent space, explosion of service economy in addition to manufacturing space have catapulted the scope for retail banking business in India. The segment has become an important component in the business design of the banks in India, and almost all players in the foreign, public and private, old and new, space are in this, and it has become almost a fashion statement for all the players. The retail plans basically stem from the enormous opportunities across geographies and customer segments and the huge untapped potential for retail banking in India. There is a virtual gold mine to be unearthed and even the top layer is not yet scratched fully. There is a whole lot of customer pyramid to be tapped and the present activities till recently were confined only to the top and higher middle end of the customer pyramid. Of late banks, especially foreign banks, and new generation private players are seriously looking at the bottom of the customer pyramid and re-engineering their retail strategies to develop independent and exclusive strategies for this segment. In addition, the recent trend is that non-banking finance companies, NBFCs, have also aggressively entered and active in this bottom of the pyramid segment and posing a big threat to the conventional banking players. RBI data on retail banking in India. The Indian retail banking is in growth trajectory. There have been several recent developments in Indian retail banking. The growth in various elements of retail banking space over the past few years are published by RBI in their bulletin, Report on Trend and Progress of Banking in India and Financial Stability Report, which reflects the business performance achieved in the retail assets and other services by banks as under. Growth rate of retail assets of the banking. See the charts from book. The above data throws open the following interesting revelations about the performance of the retail banking segment in the recent past. Performance of different segments of retail banking from 2015 to 2017. 1. Banks retail loan portfolios registered double-digit growth. The housing loan component, which contains more than 54% of the total retail loan portfolio of banks, increased by 15.17%, albeit there is slight decline in growth as compared to the corresponding previous period. Retail loan portfolio of the banks continued to grow at around an average 18.41% during 2016 to 2017, even though there was deceleration in the total credit growth of banks. Auto loans also recorded a recovery. Credit card receivables grew by more than 30%. The significant growth has emerged since several quarters: mortgage loans, housing, personal loans, credit cards, etc. 2. Weak domestic demand and subdued performance of the corporate sector moderated the demand for HUC-CIT. As a result, at the end of March 2017, gross outstanding credit of scheduled commercial banks increased by 8.0% to 80,818 billion rupees, as against an increase of 13.7% during the corresponding previous year. Personal housing loans witnessed higher growth at 20% in 2015 as against 8.58% in 2016. Credit to professional and other services sector grew at 26.94% in 2017 as compared to 6.58% in the previous year. 3. The geographic reach of ATMs increased further as the number of ATMs installed increased to around 0.22 million as at end March 2017, an increase of 4.61% over the previous year. PSBs maintained more than a 70% share in the total number of ATMs. Foreign banks, however, continued to post a decline in the number of ATMs. As per the reports, all the bank branches are reportedly under CBS coverage, and India today has a spread of more than 222,000 ATMs across the country as against 132,600 ATMs in 2016. The number of ATMs as a percentage of bank branches was at 166% as on March 2017. Indicating the approach of the banks in customer migration from branches to electronic mode. To add, the number of on-site and off-site ATMs reflects that banks are serious in not only making the ATMs available in the branches, but also had increased the convenience factor to enable the customer to use the ATMs in away from branch locations also. At different and convenient points, regional distribution of ATMs became more balanced with the share of metropolitan, urban and semi-urban centers in total installed ATMs varying between 26.0% and 29.0%. 4. During 2015 to 2016, the number of white label ATMs, WLASs, which are owned and operated by non-bank entries, increased significantly to 12.962 from 7,881 during the previous year. This spurt in WLAs can be attributed to the entry of new players in the banking space such as payments banks and small finance banks, which are collaborating with WLA operators rather than having their own ATMs to minimize costs. 5. Growth in the number of outstanding debit cards maintained by and large even in 2016 to 2017 from 40.3% in 2014 to 2015. During 2014 to 2015, the spurt in debit card growth was attributed to the Pradhan Mantri Jan Dhan Yojana, PMJDY, under which every account holder under the scheme was issued a RuPay debit card. As the growth in account opening under PMJDY decelerated, this resulted in a decline in the growth of debit card issuances. 6. However, credit cards registered increased growth of 35.90% during the year as against 26.73% during 2015 to 2016. Bank group-wise, PSBs maintained a strong lead in issuance of debit cards with a share of 82.8%. On the other hand, private sector banks, PSBs, had a dominant position in credit card issuances with a share of 60.1%. 7. Retail electronic and card-based payments registered a quantum jump in the past 2 years mainly due to increased use of real-time gross settlement, RTGS, and National Electronic Funds Transfer (NEFT). Real-time gross settlement (RTGS) and National Electronic Fund Transfer (NEFT) have increased rapidly, assisting the volume and value of transactions, though wholesale remittances constitute a major proportion of RTGS transactions. The concept of electronic remittance mechanism is picking up fast over the years, and this trend offers potential to package a remittance product as an add-on in their retail banking package to the customers. 8. Due to greater use of prepaid payment instruments, PPIs, for purchase of goods and services and for fund transfers, the value of transactions by these instruments has increased considerably in recent years. Among the prepaid instruments, PPI cards, which include mobile prepaid instruments, gift cards, social benefit cards, foreign travel cards, and corporate cards, remain the most popular mode, followed by mobile wallets. During 2016 to 2017, the value of transactions through PPI cards and mobile wallets increased significantly to 838 billion rupees and 13,105 billion rupees respectively, against 488 billion rupees and 4,041 billion rupees respectively in the previous year. The different scenarios in retail banking indicated different dimensions of retail banking and its impact on profitability. Retail banking is a critical source of revenue and profitability for most major banks around the world. According to a research study by Boston Consulting Group, retail segment brings in nearly 60% of the total banking revenues worldwide. It is expected that this situation will continue and retail banking will remain the dominant source of revenue for banks worldwide through the years to follow. But the fact is that retail banks are facing tougher competition and continuously declining margins, and to overcome this, banks have to develop winning business models and requisite skills. Prerequisite for success of retail banking. There are various factors that can subscribe to the success of retail banking in India, a few of which are listed herein below. Presence of an efficient delivery mechanism. It is the most important prerequisite for retail banking to succeed. What essentially binds customers to their bank is the quality of services offered, the fairness and affordability of pricing, and the promptness of service. While there is not much scope for the banks to differentiate their product and service offerings, insofar as the basic products are concerned, it is important for the bank to enhance the customer experience by ensuring that the services are made available whenever and wherever the customer demands them. Further, the banks can bring down their cost of service delivery, if and only if they are able to improve operational efficiency. In a nutshell, the banks should be able to deliver the products and services to the customers in safe, secure, prompt and cost-effective manner by leveraging technology. Product appropriateness. Another essential precondition for the success of retail banking is appropriateness of product and services for the customers. As the banks strive to bring in new customers into their fold and also to retain the existing ones, they must invest heavily into data analytics and assess what are the appropriate products and services for the specific groups of their customers. The banks have to be sensitive about the customers' needs and requirements. Pricing. The pricing demonstrates that the products and services, both on the liability as well as on the asset side, are heavily weighed against the retail customers as a group. Scoring models for assessing the credit worthiness. The scoring models are being used for assessing the credit worthiness of borrowers to bring in greater transparency and efficiency. Credit scoring model is a statistical technique that combines several financial characteristics to predict the behavior of new applicants based on the performance of existing borrowers. Some banks started employing credit scoring even in retail segment. Most of the banks are using credit information reports to assess the financial discipline of the applicants. This is also based on scoring. Consumer protection environment. Across the globe, the regulators and supervisors are turning increasingly intolerant of unfair market practices adopted by the market participants. It has been observed that large amounts of penalties are levied on banks by the regulators mainly for failing to protect consumers' interests and for unfair practices. More focus needs to be given to develop conviction on the customers that their rights are adequately protected. This has culminated in creation of separate authorities for enforcing fair market conduct and for protection of financial consumers. Therefore, unless the banks in the developing countries are firmly committed to treating their customers fairly and put in place appropriate systems and processes, they would be well advised to refrain from riding the bandwagon of retail banking. Challenges for retail banking. Consumer protection and pricing. There are several examples reported on pricing being arbitrary and, to a certain extent, illogical. There are charges for non-maintenance of minimum balance, charges for check return, and there are charges even where no service has been provided, customers not conducting any transactions, etc. Another disquieting feature in the pricing of products and services by banks, and that is a poor subsidizing the rich. For the retail banking model to be successful, banks' pricing should be non-discriminatory, risk-based, competitive, and value-added. Inadequacy of MIS. A crucial input for success of any business is the accurate, consistent, and granular information about its various components. The data on segmental revenues and segments of profits are not available with any granularity. Under the circumstances, the banks would find it very difficult to make their pricing risk-based. It is crucial, therefore, that if the retail banking has to be rolled out successfully, the banks would need to build an appropriate MIS. Understanding of KYC/AML issues. The banks in the developed countries have faced significant amount of penalties from the regulators for their failure to conduct adequate due diligence on their customers. Even in India, RBI had imposed penalties on some of the banks for their failure to have proper due diligence on their customers. It is important, therefore, to understand and appreciate KYC requirements in all manifestations, be it for the products on the asset side of the balance sheet or on the liability side. Banks would also need to be mindful about the KYC due diligence for the third-party products that they sell from their premises through their delivery channel. Consumer protection environment. Across the globe, the regulators and supervisors are turning increasingly intolerant of unfair market practices adopted by the market participants. It has been observed that large amounts of penalties are levied on banks by the regulators mainly for failing to protect consumers' interests and for unfair practices. More focus needs to be given to develop conviction on the customers that their rights are adequately protected. This has culminated in creation of separate authorities for enforcing fair market conduct and for protection of financial consumers. Therefore, unless the banks in the developing countries are firmly committed to treating their customers fairly and put in place appropriate systems and processes, they would be well advised to refrain from riding the bandwagon of retail banking. Challenges for retail banking. Consumer protection and pricing. There are several examples reported on pricing being arbitrary and, to a certain extent, illogical. There are charges for non-maintenance of minimum balance, charges for check return, and there are charges even where no service has been provided, customers not conducting any transactions, etc. Another disquieting feature in the pricing of products and services by banks, and that is a poor subsidizing the rich. For the retail banking model to be successful, banks' pricing should be non-discriminatory, risk-based, competitive, and value-added. Inadequacy of MIS. A crucial input for success of any business is the accurate, consistent, and granular information about its various components. The data on segmental revenues and segments of profits are not available with any granularity. Under the circumstances, the banks would find it very difficult to make their pricing risk-based. It is crucial, therefore, that if the retail banking has to be rolled out successfully, the banks would need to build an appropriate MIS. Understanding of KYC AML issues. The banks in the developed countries have faced significant amount of penalties from the regulators for their failure to conduct adequate due diligence on their customers. Even in India, RBI had imposed penalties on some of the banks for their failure to have proper due diligence on their customers. It is important, therefore, to understand and appreciate KYC requirements in all manifestations, be it for the products on the asset side of the balance sheet or on the liability side. Banks would also need to be mindful about the KYC due diligence for the third-party products that they sell from their premises through their delivery channel. Managing risk. The retail banking business involves dealing with a large number of customers over varied delivery channels, thereby creating significant vulnerabilities across banks' systems. These could be in the form of inadequacy of internal guidelines or non-adherence by staff, inadequacy in the technology systems supplied by vendors, fraudulent practices employed by customers, hackers, etc. Though banks have developed sufficient safeguards to deal with operational risk associated with traditional delivery channels, it is essential for adequate safeguards for non-traditional delivery channels, as evident from large number of technology-related frauds being witnessed across Indian banks in the past few years. The banks would also need to recognize and manage risks arising from mis-selling, etc., besides the other business risks like market risk, liquidity risk, interest rate risk, etc. Unless banks address these issues quickly, even the low-value frauds would have the potential to cause reputational risk and unwarranted litigation for the banks. It is, therefore, absolutely important that the banks improve their risk management systems to address these issues. Effects of disruptive new technologies. With the increased proliferation of alternate delivery channels, ATMs, internet and telephone banking, retail banking has become the segment impacted most by technology. While the use of technology-aided delivery channels has grown multifold, so has the scope for fraudulent transactions through impersonations and identity thefts. Banks would also need to quickly put in place lasting technology-based solutions to thwart the efforts of fraudsters and minimize the customer complaints. As the use of new delivery channels gets more popular, the banks would need to ensure that their customers continue to have good experience with their service offerings and remain loyal to them. Continuing growth. Despite banks' concerted efforts on increasing the banking penetration and bringing more and more adult population under the formal financial system over the last 7 to 8 years, more than half of the target population remains uncovered. Similarly, the credit penetration from the banking system in the country is abysmally low at about 10%. In absence of access to formal sources of finance, the alternate cost of funds for the people is exorbitantly high. As the pricing of loans no longer remains restricted due to any regulatory government fiat, the banks are free to reasonably charge their customers. All these means that the retail banking has a huge potential to grow in India over time. It is, therefore, assumed that the challenge for the retail bank's banking is not one of finding new customers or new markets, it is more of a mindset issue. The banks need to get convinced about financial inclusion as a viable and profit-making business proposition and pursue that objective with a missionary zeal. The growth of retail lending, especially in emerging economies, is attributable to the rapid advances in information technology, the evolving macroeconomic environment, financial market reforms, and several micro-level demand and supply-side factors. In the context of retail lending, Deployment of scoring models would minimize the subjective element and thereby fast-track the decision-making process. Quality of services offered by the banks is going to be another key differentiator. In ultimate analysis, providing better service to the customers would be the key to generate larger revenue for the banks. Reasons for the growth of the retail banking segment. There are various reasons that contribute to the growth trajectory of retail banking segment, a few of which are as under. A. Rise of the young Indian professionals. The rise of the Indian middle class is an important contributory factor in this regard. The percentage of middle to high-income Indian households is expected to continue rising. The younger population not only wields increasing purchasing power, but as far as acquiring personal debt is concerned, they are perhaps more comfortable than previous generations, improving consumer purchasing power, coupled with more liberal attitudes toward personal debt, is contributing to India's retail banking segment. B. Growth as an economic superpower. Retail banking has played a role in a growing economy of India. As the growth story gets unfolded in India, retail banking is going to emerge as a major driver. A.T. Kearney, a global management consulting firm, identified India as the second most attractive retail destination of the 30 emergent markets. C. Increasing purchasing power of middle-class people. The rise of the Indian middle class is an important contributory factor in this regard. The percentage of middle to high-income Indian households is expected to continue rising. The younger population not only wields increasing purchasing power, but as far as acquiring personal debt is concerned, they are perhaps more comfortable than previous generations. Improving consumer purchasing power, coupled with more liberal attitudes towards personal debt, is contributing to India's retail banking segment. D. Financial market reforms. The subject matter of retail banking is of prime importance. In recent years, commercial banks have witnessed development in the form of retail lending all over the world. The growth in the field of retail lending is primarily because of the speedy advancement in the IT sector, evolving macroeconomic environment, numerous micro-level demand and supply-side factors, and financial market reforms. This criterion is based on the market research report on retail banking. Engine of economic growth. Retail banks play a critical role in their home economies, and their activities have implications for the global economy as well. They offer critical credit functions, which largely fuel the engine of economic growth in their economies. When problems hit the retail banking sector, the result is often dire economic circumstances for the economy as a whole. When retail banks are failing, little or no credit is available for credit seekers, and economic activity becomes depressed. F. Mass market banking. Retail banks offer a variety of important services to their customers. The retail banking sector is often described as a typical mass market banking, offering services such as savings and operative accounts, and all kinds of personal loans, including auto loans and student loans. Retail banks also offer mortgage services, debit and credit card services, and ATM services, all of which have become essential to today's consumers. G. Volume-driven business. Retail credit ensures that the business is widely dispersed among a large customer base, unlike in the case of corporate lending, where the risk may be concentrated on a selected few. Ability of a bank to administer a large portfolio of retail credit products depends upon such factors like strong credit assessment capability, sound documentation, adequate capital base, regular constant follow-up, skilled human resource, and technological support. H. Automation of banking process. The growth in retail banking has been facilitated by growth in banking technology and automation of banking processes to enable extension of reach and rationalization of costs. ATMs have emerged as an alternative banking delivery channel which facilitates low-cost transactions vis-à-vis traditional branches method of lending. It also has the advantage of reducing the branch traffic and enables banks with small networks to offset the traditional disadvantages by increasing their reach and spread. Easy and affordable access. Banks provide retail loans through a wide range of options flexibility. Banks even finance cost of registration, stamp duty, society charges, and other associated expenditures such as furniture and fixtures in case of housing loans and cost of registration and insurance, etc., in case of auto loans. Financial liquidity. Banks making financing attractive by offering free concessional value added services like issue of credit card, insurance, etc. As also waiver of processing fees, administration fees, prepayment charges, etc. by the banks. In many a case, the cost of retail lending is restricted to the interest costs. Economic prosperity. The consequent increase in purchasing power has given a fillip to a consumer boom. Note that during the 10 years after 1992, India's economy grew at an average rate of 6.8% and continues to grow almost at the same rate. Not many countries can match this performance. Changing consumer demographics. The size of population indicates vast potential for growth in consumption both qualitatively and quantitatively. India is one of the countries having highest proportion, 70%, of the population below 35 years of age, young population. BRIC report of the Goldman Sachs, which predicted a bright future for Brazil, Russia, India and China, mentioned Indian demographic advantage as an important positive factor for India. Technological innovations. Technological factors played a major role. Convenience banking in the form of debit cards, internet and phone banking, anywhere and anytime banking has attracted many new customers into the banking field. Technological innovations relating to increasing use of credit debit cards, ATMs, direct debits and mobile banking has contributed to the growth of retail banking in India. Increase the bank liquid cash, treasury income of the banks, which had strengthened the bottom lines of banks for the past few years, has been on the decline during the last 2 years. In such a scenario, retail business provides a good vehicle of profit maximization considering the fact that the share of retail banking in impaired assets is far lower than the overall bank loans and advances. Retail loans have put comparatively less provisioning burden on banks apart from diversifying their income streams. Decline in interest rates. The interest rates decline in Indian money market has also contributed to the growth of retail credit by generating the demand for such credit. The interest rates on retail loans have declined from a high of 16 to 18% in 1995 to 1996 to presently in the band of 7.5 to 9%. Ample liquidity in the banking system and falling global interest rates have also compelled the domestic banks to reduce it. Declining cost of incremental deposits. Banks could afford to quote lower rate of interest as low cost, saving bank, and no cost, current account, deposits are available with the bank. These deposits contribute to more than 1/3 RD of their funds, deposits. The declining cost of incremental deposits has enabled the banks to reduce their interest rates on housing loans as well as other retail segments loans. Change of terms of loans. Banks are offering retail loans for short-term, medium-term and long-term ranging from 15-30 years as compared to the repayment period allowed earlier which was restricted to 5 to 7 years only. This has given more financial leverage to people. Scope of retail banking in India. A. Increase in economic activity is taking place with some recessionary trends. B. Increase in purchasing power. The rural India has more purchasing power at their disposal, and this is an opportunity to market retail banking. C. India has 200 million households and 400 million middle-class population. More than 90% of the savings come from the household sector. Falling interest rates have resulted in a shift. Now people want to save less and spend more. D. Nuclear family concept is gaining much importance, which may lead to large savings. The number of banking services to be provided is increasing day by day. E. Tax benefits are available. For example, in case of housing loans, the borrower can avail tax benefits for the loan repayment and the interest charged for the loan. Let us sum up. Medium black circle banking services offered to a large group of individual customers is referred to as retail banking. Times the delivery model of retail banking is both physical and remote through branches and also through remote channels like ATMs, internet banking, and mobile banking. Retail banking has many advantages as a business segment for banks. Risk is less as client base is large. Income is relatively more as spreads are more. Customer loyalty will be strong. Stable model with less volatility in business as the client base is very large. Higher potential for cross-selling, but it has its own disadvantages also. Huge clientele requires more efforts for monitoring and tracking. Cost of servicing will be relatively high. Delinquency is relatively higher in unsecured retail loans like personal loans and credit card. Receivables. Retail banking. Introduction Vertical bar 17. Globally, the retail banking space had a great growth trajectory, and the emergence of the new remote channels has changed the distribution paradigm of banks. Alternate channels have gained prominence to meet the growing customer demands. The performance of banks in retail banking across the globe had a stable growth. The potential for retail banking based on customer segments and household incomes looks highly promising. The growth potential in Asia and South Pacific is very attractive, and the numbers are expected to grow in the near future. Retail banking as a concept in India has been initiated by foreign banks, new generation banks, and nurtured by the PSBs and other private sector banks. It grew by a compounded annual growth rate between 2016 and 2017 and expected to grow further in the coming years. The penetration level of retail banking in India is still very low as compared to the other Asian countries like China, Malaysia, Thailand, etc. Check your study. 1. Advantages of retail banking include: risk is less as client base is large. Income is relatively more as spread is more. Stable model with less volatility. 2. Which one of the following is not an advantage of retail banking? A. High cross-selling potential. High default rates. 3. Which one of the following is not part of retail banking? C. Providing term loans for projects.